So as we look at the fixed income market, as mentioned earlier, bonds have not been doing well this year. Interest rates are going up, which means bond prices are going down. And one of the questions about the economy is, if the Fed starts to get overly aggressive and raise rates too fast and starts to push down what we see as rising inflation, that's happening. We're starting to see the early signs of inflation. If we see this inflation rise, will the Fed get aggressive and will that hamper the economy? And that's an important question. And so question one in our fixed income review is, are we really in a tightening cycle? The answer is, of course. The Fed is raising rates. They've been doing it consistently, and they have signaled they will continue to do that. However, an important number to take note of is what is called the real rate. In other words, the real Fed rate is taking the actual rate that the Fed charges and subtracting out inflation. Right now, despite many increases by the Fed up to this point, we're just getting back to zero. It has been our stance throughout this entire growth process and the Fed's activities around putting staggering amounts of money into the market and taking rates to zero, that they have been overly accommodative, that they put too much money in. And we can see in this chart in 2011 and 14, all the way through 16 and 17, the Fed was actually at a negative real rate, meaning that the rate was below inflation. So as we look today, we're just now crossing zero. To go back to 2006, 2007, just before the last market downturn, we were almost 3% in a real rate. So we've got a long way to go before we actually see the real rate signal a tightening. I think we're just getting back to normal. There's still room here for the Fed to increase rates without having a major impact on the economy, but that's a technical issue. The market may decide it's nervous and impact prices ahead of the actual outcome. So we're at zero. We don't think we're overly tight yet, but it is something to monitor based on the path that we're on. We've said in prior quarterly reviews that the great bond unwind is underway. And again, this year, it's just continuing to break away. This chart shows bond prices, 10-year yields, going all the way back to 1979. And as we can see, we had a 37-year downturn in yields. Well, if yields go down, bond prices go up. That means we had a 37-year bull market in bonds. This is very important. When you have a bull market that's that long, when you reverse it, it will have significant impact across the financial markets. And so as we see here, the chart shows a perfect channel. The red lines show the tops and bottoms of a perfect channel that lasted from 1987 to 2017. We've now broke that long-term trade channel. We're back up. We're now over 3%. We actually hit 3.25 just a couple days ago. And it looks to us, based on the economy, based on how well the U.S. is doing versus the rest of the world, based on inflation, that there's more room for this to go higher. So what does that tell us? It tells us we have to remain cautious in our fixed income portfolio. Floating rates still look good. We want to continue to stay in the lower durations. But as it goes up, we'll start to pull away from that overly defensive posture and look for opportunities. We're just not there yet. Be daring. Go against the crowd. Right now, as we look around the fixed income markets, we have to look at the whole world's fixed income markets. Because of the trade war concerns, the emerging markets have gone down significantly, and emerging market debt has really come under serious pressure, therefore reducing price. Interestingly, here in the United States, high-yield securities have continued to go up in price. In other words, yields have gone down. This is really important. Why? Because in the U.S., everybody's so confident in the economy, no one believes there's going to be defaults. And because of that, the spread to treasuries, in other words, the yield of a high-yield bond versus a treasury, the difference in those two numbers is a spread. Spreads are remarkably low right now. You're not getting paid an awful lot of money in the U.S. high-yield market to take on the risk of a junk bond. However, in the emerging markets, spreads have widened significantly because of tariff war concerns. Well, again, we always want to buy sunglasses in a rainstorm and buy umbrellas on a sunny day. And so as we look at this next chart, it shows the relationship between emerging markets and high yield. Why those two? Because those are more volatile fixed income assets. When the chart is high, emerging markets are expensive versus high yield. And when the charts are low near the bottom, that tells us that emerging markets are inexpensive versus high yield. So as we can see, we're at extraordinarily low prices. We have to go back to 2005, the last time we saw this kind of relationship. And what happened in the subsequent years, emerging markets bonds had wonderful returns over the next couple of years. So something we're looking at. The challenge, of course, is emerging markets are extraordinarily volatile. So this is something we have to do carefully, deliberately, and bite it off in small pieces in a very deliberate, gradual pattern. But it is, without question, an opportunity if, again, we stay focused on long-term investing.